Well, my name is Rick Drew. I'm the president of the board of Canyon Country Advisory Committee, as most of you already know. I've been preparing income taxes for the last 25 years. I have a small practice out of my home, and so I don't make any money at it. I just do it to keep myself busy more than anything. But you have to do a lot of education to figure out what's going on. Well, this year, they passed a new tax law on December 22nd, 2017. It was passed. It's called the Tax Cuts and Jobs Act. And it's supposed to be made our tax laws a lot easier, a lot more simplified. And the 1040 was supposed to be a postcard. Well, when they started proposing this, we started looking at the laws and things that they did. And the first thing I noticed was they were doing away with what they call a personal exemption. Personal exemption is something that when you do your taxes, most people don't take it for granted because it's an automatic that came off of your taxes. It came off of your income. Of an exemption is $4,050 per person. And so families, like my son has got 3 kids, that's almost $21,000 personal exemption that would come off of his income before they started figuring out his tax. Well, the TCJA did away with personal exemptions. Now they doubled the size of, oh good, we got the goodies up here now. It's the largest tax cut in 30 years. A little more than 30. It was 86, I think, was the last time they played with the taxes. And there's a lot of changes. And it was, like I said, it was advertised as a simplify the U.S. income tax. So the 1040 was advertised as a postcard, but there used to be 3 different 1040 forms. There was the 1040, which was the long form. And then people say, oh, we want to do the short form, which was either the 1040A or the 1040 Easy. Well, they've eliminated the 1040A and the 1040 Easy because we just have the 1040 postcard. Well, so that created what they showed was a postcard. It's 2 halves of a page of paper. And what they did was they just took the lines off the 1040. So a lot of this stuff, I always keep saying it's kind of like smoke and mirrors. And it's simplified. That's what they told us. I've done about 40 hours worth of education so far learning about this tax cut to know what I'm doing, and that could be questionable still. With the new 1040, which is only a postcard, they've added 6 schedules to the 1040. So now not only do you have just Schedule A, Schedule B, and so on, of what's normal taxes were. Now we have schedules 1, 2, 3, 4, 5, and 6 that are added on after the 1040. So like I say, it's smoke and mirrors. Here's a picture of the 1040, which all you do is you list your name, address, your dependents, and a place to sign. That's the front page. Back page is you throw in all your figures and tells you what your tax is at the bottom. But then you get Schedule 1. Schedule 1 is where you list all your income. Well, that used to be on the 1040, now it's on Schedule 1. So, simplified. Oh, now we have Schedule 1. Schedule 2, now we have, that's where the tax goes. So this was all, like I say, it was all on the 1040. There was a spot for tax, or for your income, and there was a section for your adjustments, and then there was a section for taxes, and then at the end. Well, they took all that off and made the simplified form. And so now you have all these schedules. Schedule 3 is non-refundable credits. And Schedule 4 is other taxes. Schedule 5 is the payments you make, your estimated payments, and all that kind of good stuff. And it's reported on there. And Schedule 6 is kind of probably 99% of the people will never use Schedule 6. But anyway, it's for foreign addresses and third-party designations for taxes. What they did is they doubled the size of the standard deduction. So this year, the standard deduction for a single taxpayer is $12,000. For a married couple, it's $24,000. For anybody over 65, so a couple of us here, you get an extra $1,600 if you're single, or you get $1,300 a piece added to your standard deduction at the end of the day. So then they also increased, more simplified. They lowered the tax brackets, but they went from 5 tax brackets to 7. So now we have 7 tax brackets. I mean, I could tell you the cutoffs. I've got the cutoffs here for the tax brackets. For married filing joint, for 10% cuts off at $19,000. Between $19,000 and $77,000 is the 12% tax bracket. If you make over $77,000 to $165,000 is the 22% tax bracket. And then we get into anything over $165,000 to $315,000, you're paying 24%. 32% is $315,000 to $400,000, and 35% is $400,000 to $600,000. If you make over $600,000 a year, you're paying 37%. It used to be 39.6%, but now it's down to 37%, so it's dropped a couple. Anyway, here's a standard Schedule A that they've still got there. The only problem is they took away most of the itemized deductions. You used to have miscellaneous itemized deductions at the bottom of Schedule A. Those are no longer there. You have medical expenses. This year, medical expenses, if you have over 7.5% of your income, you can take medical expenses. Next year, it goes up to 10%. It was 10% for a while, dropped down in 2017 to 7.5%, back to 7.5%. So medical expenses are still there. Then you have your the tax for your property taxes, your DMV fees, your state and local income taxes that you pay. The only problem is they capped it all at $10,000. So you get a deduction of only $10,000 maximum for any of those taxes. So if you pay $12,000 in property tax, you get $10,000 credit, or $10,000 deduction. You don't get the $12,000. And then I do have a client who's got a $14,000 property tax, and they got another $10,000 they pay in state income tax, and it's only capped at $10,000. They only get $10,000 benefit. But that's what we've done with that. Then you take your mortgage interest. The mortgage interest has been cut. Now it's a mortgage of $750,000. It was a maximum of $1 million you could take interest on, but now they dropped it to $750,000. Most people here don't have that big a mortgage, but that's the cuts that they did make for that. As I said, the medical was 7.5%, and it goes to 10% next year. And if you take mileage, if you drive to the doctor and all that, which is deductible, if you do take medical, then it's 18 cents a mile is what you get for that. As I said, state and property taxes, DMV fees are limited to $10,000. Mortgage interest on a home's deductible up to $1 million, but now is limited to $750,000. Charities are deductible, and they raised that up. Charities used to be deductible only to 50% of your income. Now they raised it to 60%, so you can give more charity if you care to. And if you do charities and you want to take the mileage, it's 14 cents. It's been 14 cents for 20 years. And it's a law, and the only way that can be changed is through Congress can change it. So it's 14 cents. It'll never change. They did away with moving expenses. You used to be able to take moving expenses if you moved 50 miles from your home for a job or something like that. You used to be able to take the expenses for that. Well, you can't do that anymore unless you're in the military. Casualty losses. Can't take casualty losses anymore unless you're in the, like the Woolsey fire, which was presidentially declared, so they can take casualty loss for the fire zone there. But any disaster, you do have to have a presidentially declared disaster before you can take your deduction. All the, like I said, all the itemized miscellaneous deductions, which were subject to 2% of your income that you took, like your tax prep fees, your unreimbursed employee expenses. I've got a couple of cops that take a lot of unreimbursed employee expenses because they get mileage to go to court, and they can write off their ammunition that they use, and they can write off they used to be able to write off all their dry cleaning of their uniforms and all that kind of stuff. Can't take any of that anymore. It's all gone. Every bit of it. So even those of you that have IRAs and investments, and they charge you a fee for those investments, which was deductible under the 2% law, those aren't deductible anymore either. None of the IRA fees or the management fees for investments. Schedule B basically stayed the same with your interest and dividends, and then we go to Schedule C, which is for sole proprietors and small businesses, and for the most part, that didn't change either. There's a few things that have added to that. There is now a qualified business expense deduction of 20%, but there's phase outs. You've got to make below a certain amount of money, and then also a bunch of service jobs aren't allowed to take the deduction. You can't be an attorney, you can't be a doctor. Health, there's about 10 or 15 different professions or areas of professions that don't qualify for the qualified business expense deduction. So they're saying you get 20% off if you're a small business owner, but it depends on what business you're in. Schedule D reports all your capital gains. The rates remain at 0, 15, and 20%. Schedule E is rentals. And rentals, the rentals, if you do have a rental, and it's basically you're trying for an income on your rental and all that, so far it's stated that you can take the qualified business expense off of the rental, but you got to show that you've got the rental, that you're trying to make a profit with that rental. So the one problem with them doing away with all the itemized deductions and giving everybody a big standard deduction is that everybody thinks, well, we won't have to keep track of all our deductions and all this kind of stuff. California didn't conform to any of the tax cuts. So for California, they still take those deductions. So it's basically, we're going to end up having to do a return for, as we did in the past, because California now takes the deductions, has a lower standard deduction, so you will get itemized deductions with the state on your state tax return. So you have to have all that information. The California return always had an adjustment after your 540. It's called California Schedule CA. The CA went from 2 pages, now it's 5 pages long, just to accommodate all of this. So California, like I say, California standard deduction is much smaller. So everybody gets the deal. So we're going to end up having to do basically 2 tax returns, or just basically not change what we've done in the past with your tax return. If you itemized, we still have to put down all your itemized, and enter all of your itemizing and keep track of all your deductions and everything, because it will go on the state, because the state didn't conform. Right now, W-2s and 1099s that you're supposed to get in the mail are supposed to be to you by January 31st. So expect them. Usually the K-1s end up showing up in April, May, June, sometimes July. They're supposed to be there by January 31st, and it never happens. But W-2s and 1099s are all supposed to be in your hands by the 31st. Taxes are due this year on April 15th. Last couple of years it's been the 17th and the 18th and all this, but finally we're back to April 15th. It's Monday, I believe. There was a process that you could do if you wanted to change your IRA from a regular IRA to a Roth IRA, and there was rules that you could change it, but if you didn't like the way the market was going or whatever, and you wanted to go back, change your mind and go back to a regular IRA, you used to be able to do that. You can't do that anymore. So if you make the election to go from an IRA to a Roth IRA, you'll have to pay the tax on it, and you can't go back. So there's no changing. Like I say, business returns have the qualified business income, the 20% deduction, and business rates, mileage rates, are 54.5 cents. So that's what you get this year on the 2018 tax return. Basically about personal. If you've got any questions, I'd be happy to ask. If I don't have the answer, I've got my handy dandy tax book here that we can look it up. Jim probably knows a thing or two, being he's a retired CPA also. But this tax year, for tax preparers, CPAs, EAs, all that kind of stuff, is a thing that's going to be a big surprise. They said, they've all the organizations I belong to and stuff all said that good luck if you're doing tax planning with your clients, because we don't know. And so everybody's tried to do the best you can, and the predictions that my computer kicked out when I was doing taxes last year on my clients was everybody was going to get a little bit of a refund here or there, extra, if they stayed the same. But then they dropped the withholding, so we don't know if that's going to happen or not. A couple of clients came to me, and we did a thing, and they had too little of being withheld. We had up their withholding just so they weren't going to owe any money when we did their taxes. But anyway, yeah, it's a simpler tax form now. Easier laws. Like I say, I've already done 40 hours worth of education. And we're all going to be flying by the seat of our pants and putting up a shield telling our clients that, we're just the messenger. Don't kill the messenger. We're just doing our jobs. So any questions? Do I have one? Oh.
I got a question.
Okay, go ahead.
The American College credit.
Yes.
I didn't see you mention anything. That's a credit
for the first 4 years of college.
You actually will get that back, no matter how much taxes you pay in, right? It's a credit that's given, or is it a return?
I think the American College, is it refundable?
I don't do a lot of individuals. Usually those credits are
Yeah,
non-refundable.
I think it's just non-refundable. There's not very few that are refundable this year.
Tax to zero, but it won't create a refund.
Reduce the return that you get.
Well, your tax liability, it'll reduce it to zero.
Oh, but you won't go beyond.
But they're not going to give you any money back.
It's not like a child credit where you
no.
Where you get
child. I didn't mention that the child credits did go up this year. They've gone up to $2,000 per child, and there's also a dependent credit. If you claim grandma or grandpa, it's $530, I think it is, as a dependent credit.
What schedule was the American College credit? Did you notice?
It's on one of the. It's the second. No, I think it's two. It's not up there anymore.
It used to be on the first page. Of
I think it's on Schedule 2.
Okay, I can find it.
Yeah, it's on Schedule 2. Yeah.
That's why you get paid the big bucks?
Well, unfortunately, fees are going up this year just because of the time we spend in education, the time and money for us to get the education, and then also just doing the preparing tax returns.
And these rules go away after 7 years,
10 years, isn't it?
2025.
Yeah, they go back to
Back to the old rules.
2017 rules, unless something's moved it around. But this is, so don't get your postcard ready.
All right, Rick, thank you. Let's give Rick a big hand.